Welcome to Dr. B.R. Ambedkar Open University programs. Today we are going to telecast a program on capital budgeting decisions for the benefit of MBA second year students. As you are aware, budget is a quantitative statement expressed in terms of monetary terms, which is for a particular period, for a definite period. Capital budgeting is also one of the budgets. In our day-to-day life, we come across different kinds of budgets where the investment is going to be blocked permanently, and the budgets that are prepared for a particular period, that is 1 year. In this context, we can say the budgets that are prepared for a short period or long period. And also we have other kinds of budgets that are zero based budgets. In this context, we are going to discuss on capital budgeting decisions. To participate in the discussions, we have two professors with us. Left to me is Professor Brahmaiah. He is a professor of finance. Extreme left to me is Professor R.K. Mishra, Director, Institute of Public Enterprises, and we are going to discuss about the capital budgeting decisions. Professor Brahmaiah, will you please explain what exactly is the meaning of investment and how it is important for industry?
You see, for any business finance or corporate finance, there are three important decisions. So, out of three important decisions, the investment decision or the capital budgeting is one of the important decisions. The second function is a financing function, and third function is a distribution of the dividend function. The investment function is the ultimate for any organization, whether it is a big or a small, whether it is a profitable or a non-profitable, or it is a service-oriented organization. The investment is a process in which the resources of the organizations are blocked in the expectation of expected return. Therefore, investment decision, there are two kinds of investment decisions, that is a working capital or the short term investment decision, and the capital budgeting is a long term decision. When the long term decision means these are the generally considered to be fixed assets of the business organization or the long term capital, plant and machinery. And all the fixed assets and all capital equipment are part and parcel of investment decision. The investment decisions of the different organizations differ. Now, for the instance, we talk about corporate financing. The project financing and the projects are investment decisions. Now, bigger than that, you have a government of India, the state governments, various infrastructure financing or infrastructure projects are investment decision. Therefore, whether it's a small organization, whether it's a government or it's a PSU, for every organization, the capital budgeting or investment decisions are utmost important for the running of the organization. If the manufacturing unit wants to manufacture the products, it requires a capital asset. In addition to the capital asset, it also requires short term capital, that is called working capital. Therefore, for any organization, the working capital and the capital budgeting are utmost important for the success, for the running of the organization.
What exactly is the investment? Investment is nothing but sacrificing the funds by the people who have surplus money with them. At the same time, the users of the money are going to be totally different. While investing in any project, there are two important factors to be kept in mind. Number one is risk and return. If the return is high, automatically this risk is going to be high. It could be vice versa. In this context, I request Professor Mishra ji, how the investment decisions are important to any industry. From the point of view of industry, how important is the investment decisions?
Thank you, Professor Swamy. Investment decisions, as Professor Brahmaiah told, are a very important aspect of the overall decision making in the corporate sector. today only there has been a meeting of the Competitiveness Council of the Government of India, and they have been discussing about investments in manufacturing sector. Now, manufacturing sector is a very important part of the overall Indian economy, and the growth of the Indian economy, it is said, depends to a large extent on how does the manufacturing sector grows. Manufacturing sector cannot grow unless there are heavy investments. We have been seeing what is happening in Japan, we have been seeing what is happening in China and in many other countries. Now, the question is, why should investment take place in a manufacturing enterprise, or as Professor Bamya told, in any other kind of enterprises? You very rightly pointed out that there are two sides of this question. One is you have the firm which needs investment. On the other side, you have the investor who makes the investment. Now, firm needs the investment, as Professor Bamya told, to mobilize different kind of resources. Investment by themselves are not active resources, they are dormant resources. But once they are there, then we can mobilize the manpower, we can mobilize other kind of resources and can activate the so-called inert resources. But unless we have investment, firms cannot assemble those resources to the extent that they would like to do. On the other hand, we can take the case of the investor. Investor would like to invest the resources provided, as you rightly put it, he gets a rate of return. If there is no rate of return for the investor, he is not going to invest the money in the business. Therefore, when the question of investment comes in the mind of investor, he always considers the two aspects, as you rightly put it. On the one side, what is the rate of return that he is going to get? On the other side, what is the risk that he will have to undertake to get that rate of return? And he does it by looking into the prospects of the growth of the industry in which he is putting money into it. Now, another very interesting thing is that when we put money in the firm, then that money is expected to produce results on account of certain things. As Professor Bamya was suggesting, it is going to increase the profitability of the enterprise. It may also increase the productivity of the enterprise. It may also make the enterprise competitive. Now, all these factors may go into the investment decision and can make the firm a very attractive proposition from the point of view of investment.
Now, when we talk about the investment, what are the important features of investment?
See, as we were discussing, the investment has its special characteristics or the features. One is the investment is today, the cash outflow is today, irrespective of the organization, and the cash inflows are the future. Therefore, there is a mismatch between cash inflows and cash outflows, and the cash outflows means the investor is sacrificing, the company is sacrificing today their cash and the investment in the business organization. Therefore, the capital budgeting or the investment decision is having capital outlay today, and it is also time consuming to construct or to create a capital investment. Once you have invested, it is difficult to take back, it will be considered as a sunk cost and the cost cannot be reversible. And another thing is the benefits are the long term. The benefits are not one business cycle or not for 1 year, it is like for a permanent or the long term. If we take consider for the case of the farming, agriculture, the paddy, growing up the paddy or the rice is called working capital for the short term, and going for a mango plantation or the other orange or some fruits, that plantation long term, it takes 5 to 7 years to get the crop yielding, and the returns will have for many years. Similarly, in the business organization, the captive assets, that plant and machinery, land and building and the factory is being created initial 3 years and the uses are for many years. Therefore, the capital investment decisions are today the commitment and the outflow is today, the benefits are the long term, and therefore, the cash inflows and cash outflows are important consideration for considering the decision. Once committed, it is very difficult to go back, because it is cannot be sold, the land cannot be sold, the plant cannot be sold, which is not being used by the similar purpose. Therefore, the basic characteristics are the longer the gestation period, you cannot convert into production in the short time. Therefore, there are 4 important basic characteristics of this capital investment or investmentation. One is cash outlay is high, huge at the initial pay. Second, once you incur, it is difficult to get back, it is irreversible, and the benefits are accruing the future for a longer time, not the benefits are not for one time. Therefore, these are the 3 important characteristics. And another thing, once you incurred, then it is difficult to modify, to alter the system. Therefore, the cash outflows have to match in terms of the inflows. On the basis of the cash inflows and outflows, one has to look into the profitability of the project, and that we call it the risk return theory or the risk return parity. Therefore, these are the important characteristics of the business. The infrastructure is having the characteristics of the investment, and the plant and machinery as the investment depending on the nature of the organization. These are the important characteristics of the capital investmentations.
It is well known that the capital available to us is very scarce, is very limited. In such a case, what is the criteria for allocating the capital? Technically, we may use a word capital rationing. How the capital rationing will work out in case of any capital budgeting techniques? I request Professor Misraji to.
I think you very rightly told that, and as Professor Brahmaya was telling, demands are very high. He was talking of infrastructure projects. Now we require about 3 lakh crores only for power sector projects. We require for telecom projects under 3 lakh crores. We require for roads under 3 lakh crores. This is all in infrastructure. But when we come to manufacturing, we require under 10 lakh crores. So now a time has come when we require huge investments in large size projects. In fact, for last 2-3 years, last 10 years, we've been talking of services sector. But as Professor Brahmaya was telling, we can again go back what PM told during last 2 to 3 days. He has been telling that the Indian economy has to get stability, and if stability has to come, in that case there have to be gigantic decisions on the fixed assets front. So naturally, I think capital rationing comes into question because demands are very high, resources in the country are not there. We see that at a rate of 25% savings, our rate of growth is about 8 to 9%. Let us take the case of China. Their savings are about 37 to 38%. Then rate of growth is about 12% or so. So I think the whole question there is how much money you have and how much of that you can put into investments of a giant sized project. So as we see what has been happening in China, the same thing will happen in the case of our country also. We have demands, demands and demands, but we don't have that much of money coming from the internal resources, and also the money that can come from FDI and other sources which can be tapped, and also I think deficit financing. So capital rationing has to be there. Now when we talk of capital rationing, then what could be the criteria for the capital rationing? And I think one very important thing there could be the importance, I think, of the projects. What are the projects? When the importance of the projects will differ again, I think, from industry to industry and also from the government. Maybe in the case of the government, all the time you will not go for projects which can give a very high rate of return. There may be projects which may be there for the purpose of security. So maybe I think when we talk of atomic installations project, maybe that will leave aside other things, but we will go for those projects. Maybe there are some projects which are for prestige. Maybe there are some projects which may not have an immediate rate of return now, but they may have a very high rate of return in the times to come. Let us say investment that we are making in poverty reduction projects. But when it comes to industrial projects, and if we restrict the discussion only to industrial projects and corporate projects, then I am sure in that case we will have to look into the profitability. That I think can be the one factor in capital rationing. The other factor, as you told very rightly, can be, I think, the risk. The third factor can be, I think, the life, the cycle of the project. What is the lifespan of the project?
The ultimate goal of any business organization is to make profit. The target to be reached, I mean the rate of return to be earned, will be decided well in advance, so as to realize the rate of return pre-decided, we plan the financial activities. So, in view of the profitability, we have to evaluate a project. To invest our money in a particular project, we have to evaluate the project, especially keeping in view the profit. What kind of techniques that are available to us to analyze the project or profitability or viability? I request Professor Brahmaiah to talk about it.
As Professor Mishra was mentioning, that capital rationing was one of the reasons to evaluate the viability of the project, financial feasibility of the project or the investment decision, because the resources are constrained and the resources are limited. Therefore, one organization wants to earn the highest profitability or the highest profit or the highest wealth maximization. In that context, the organization or the investment decision has to consider what is the total investment required or the outlay from the investment, and what are the cash inflows which are generated from that project or from that investment decision are to be counted. But the interesting and the difficult issue in the capital investment is that cash inflows are immediate, cash outflows are immediate, and cash inflows are for the period of future period. Therefore, estimating future cash flows and today's cash flows is not in a uniform benchmark. The time, as you all know, money has a time value. The cash outflows which today have a more time value than the cash inflows which are generating after 5 years, after 10 years have the less value. Therefore, all these cash inflows have to be matched at one uniform benchmark. Then we have to compare the profitability and the present value of this. Traditionally, the corporate world uses two kinds of techniques. One is a traditional techniques, another one is discounted cash flow methods. Under the traditional methods, the priority over the project appraisal or priority of the investment decision is to invest in projects which can give the shorter payback period, the projects which can give the immediate returns, immediate profits. That means like a bird in hand is much than the two in the bush. Under that concept, traditionally the investment projects are taken with a short term origination, like most of the farming is for food crops like 1 year crop, 6 months crop, 3 months crop, and plantation is priority is little late because the future is uncertain. When the project is longer, the riskiness of the project is very high. Therefore, one has to expect higher rate of return. The another technique which we generally consider is accounting rate of return, where the investment and the return is calculated from the accounting perspective. What is the return ROI or the accounting rate of return? The return generated from the project is divided by the investment of that project is considered called the rate of return. But since it is not 1 year return and 1 year not investment, therefore, they consider generally the average return, that is if a project is for 5 years, they take as an average return for 5 years, and the investment is also used an average concept. Therefore, they will arrive at the average rate of return. But these two methods do not take into account the time value of the money. Both are in absolute figures. A rupee today and a rupee after 1 year, a rupee after 2 years is treated as 1 rupee. But this limitation is that because the longer the time, the returns are coming at the later stage will give a less economic value. In order to eliminate the time value concept, there is a technique called discounted cash flow methods. Under these discounted cash flow methods, what does it take? It takes a compounding interest or a compounding discount effect into the thing. If today's cash flows are taken into tomorrow's date or the after 5 years date, that is called compounding, and that future cash flows are brought back to today, it is called present value concept. And therefore, in the business decision, since we are taking a decision or the business organization taking a decision today, therefore, cash flows are brought back to today. All cash inflows and cash outflows are brought back to today, and that is called as gross price. How do we bring that after 1 year cash flows today or after 2 years cash flows? There is a mechanism called discounting. Then you may ask, what is a discounting rate and how to bring the discounting rate? That differs from organization to organization. on two important aspects. One is the cost of capital of the project or the cost of capital of that investmentation, and the riskiness of the project or the riskiness of that investmentation are added together and taken into account for consideration, and they decide the hurdle rate or the benchmark rate. With that rate, all cash inflows are discounted, inflows as well as outflows for the today's date, and those cash inflows they compare. If the cash inflows are greater than the cash outflows, then that project is a positive, that project is acceptable. And if the inflows are less than the outflows, then the project is negative, therefore that project is not viable, therefore the corporate or the business entity will not take up that project. And the cost of capital is increased, the discount values come down. If the cost of factor or the discount factor is reduced, your cash inflows are increased. Therefore, depending on the cost of capital and the discount factor, your cash flows are adjusted, and taking the decision in view of the opportunity cost of the business firm, or we call it a required rate of return or opportunity cost of capital. These two are the benchmarks which decide an investment is viable or it is towards wealth maximization. Another important technique which is close to NPV is called IRR, that is internal rate of return. It is the same thing, internal rate of return, but in a different form. In the case of the present value, we have discounted the cash flows with a certain rate, certain cost of factor, but in the IRR, internal rate of return, it is the interest rate or the cost of capital which equates cash inflows and outflows. Therefore, the internal rate of return at which the cash inflows and outflows are equal, that means the NPV is 0. If IRR is decided that IRR is greater than the cost of capital or IRR is greater than the required rate of return, that project or those projects are accepted. Otherwise, projects which give higher IRR are considered to be profitable projects. These are the basically two important techniques. One is the traditional methods, another is a discounted method. Both methods are being used by the business organizations when they take investment decisions.
When we compare these two techniques, traditional as well as discounted cash flow techniques, in what way discounted cash flow techniques are superior than traditional techniques of capital budgeting?
As Professor Bamaya was telling, and you also told, that there are two types of investment decisions, one short term, the other one long term. In the case of short term decisions, maybe I think payback and traditional techniques can do better, but when it comes to long term decisions, where you both told that risks are invisible, at the same time cash inflows are also invisible, the scientific techniques or the modern techniques, they are more pertinent, because as has been explained by Professor Bamaya, they take into consideration the long term inflows, they take into the consideration the long term outflows, and as both of you told, they also bring into question the hurdle rate or the risk rate. And as both of you have told, it is just not an imagination in the form of hurdle rate that gives us an instrument to discount the cash flows. A lot of thought goes into deciding as to what would be that hurdle rate, because there we take into consideration factors which are known, the factors which are which we can guess. We also provide some leeway for things which we can't visualize, and therefore I think the traditional techniques are good only for short term decisions, small businesses, but as both of you told, when it comes to large investments, when it comes to gigantic projects, when it comes to projects which have a long term repercussion, I am sure that we should go for only discounted cash flows of two types, the NPV and the IRR.
The important task when we talk about capital budgeting is estimation of cash flows, estimation of future cash flows. In this context, how do we calculate the future cash flows? Professor Bamaya.
When the business organization is contemplating of investment of a decision, it has to estimate the profitability. To arrive at the profitability is accounting terminology, but for project acceptance decision it requires what is an IRR or what is the Npv, net present value. For that, arriving at the net present value is nothing but the present value of cash inflows minus present value of cash outflows, that is called NPV. Now, to arrive at the cash flows, it is very simple. Cash flows, the name itself is evident. As we calculate the sales figure, the cost of goods sold, then you have operating gross profit margin, then you have operative and administrative expenses. Now, one arrives at EBITDA, that is earnings before interest, depreciation and tax. Then because since that discount rate is used as a cost of capital or IRR is rated, interest is not deducted, then what will happen? The profit after tax is arrived, depreciation is calculated and profit after tax, and after paying the tax, and per PAT 2 adjustments has to be added. One is all non-cash expenses are to be added, like depreciation, amortization, non-cash expenses have to be added back to PAT. And similarly, the interest portion, if it is already made a provision in the P&L account to arrive at the profit at tax for income tax purpose, the interest is also to be added back. Then any non-cash incomes which are shown for accounting purpose, those are also to be deducted. That will be the net cash accruals for that business. And then for cash outflow is already taken into account, therefore, from that cash inflows, and it is to be discounted at a discounted rate, that is called a cash flow.
Okay, today we have discussed about the capital budgeting techniques, its need, importance, role, and the various techniques that are employed to evaluate a project are being in detail discussed by, presented by our experts who are right now in the studio. In this context, I thank Professor R.K. Mishraji for being with us and participating in the discussions. Let me also thank Professor Brahmaya for being with us. Within a short notice, he is able to attend and participate in the discussions. This program, I presume that definitely it will be helpful to the students of MBA program who is going to pursue Dr. B.R. Ambedkar of University programs. Thank you.